Okay, good morning, everyone, and welcome to this morning's Coffee Microcaps Morning Meeting. You're all very welcome. For anybody who's joining us for the first time, my name is Mark Tobin. I'm the founder of Coffee Microcaps, and I'm quickly just going to run through some intro slides, and then we're going to get straight into it with our first presenter. I'd like to just mention our sponsor for all our virtual events here, Coffee Microcaps DMX Asset Management. If you're looking for a smaller microcap fund manager, please check out their website for the PDS and financial services guide, or indeed contact Stephen or Michael on the contact details on this slide. Quick compliance and disclaimer slide. For anybody who hasn't joined us before, the companies we normally have presenting on here are generally on a weekly basis, capped under 300 million in revenue and approaching cash flow break even, or indeed are already profitable. Generally, we don't have companies from the resources or biotech sectors, what I like to call industrial microcaps, which encompasses pretty much every other sector: microcap financials, technology, consumer cyclicals, consumer defensive, industrial companies. Structure this morning's webinar, we've got 3 presenters, each with a 30-minute slot, which we're going to break down into a 20-minute preso and 10 minutes of Q&A. If you do have any questions for any of our presenters, please type them in the Q&A box rather than the chat function in the nav bar. It just makes it easier for me to moderate the questions to our presenters. And please note the webinar is being recorded and will be posted on the Coffee Microcaps YouTube channel tomorrow morning. You can follow us pretty much on all the socials: Twitter, YouTube, LinkedIn, and I also write a free monthly newsletter that you can sign up for on the Substack platform. And our running order this morning, we're going to quickly go to Tony Abrahams, now co-founder and CEO of AI Media Technologies. After Tony, we've got Iain Dunstan, CEO and MD of Gratifii. And then finally this morning, we've got Mohan Jesudason from X2M Connect. So I'm going to stop sharing my screen here and hand you over to Tony, who I know is waiting patiently there.
Thanks very much, Mark. I'll just pull up my screen share and hopefully, Mark, is that the right one?
Yeah. It's
great.
Tony.
Awesome. Well, thanks very much. My name's Tony Abrahams, co-founder and CEO of AI Media, and I want to acknowledge the traditional custodians of the lands on which we're all joined. In my case, it's the Gadigal people of the Eora Nation. Pay my respects to their elders, past and present. AI Media is a global technology company. We deliver live and recorded captioning, transcription, and translation, but our focus is increasingly on live. We have had a really strong transformational year in FY22, off the back of a transformational acquisition that we did in May of 2021. So the full year highlights we're very proud of. It was 22% year-on-year revenue growth, although that actually included a full 12 months of our EEG acquisition compared to only 2 months in FY21. So quarter on quarter, the revenue has been pretty flat, but this has been really a story of increasing the quality of that revenue. And the quality of that revenue has improved as we have increased the amount of higher margin products that we are selling. And those higher margin products that we are selling are in that second box on the top. It's largely the Lexi and Smart Lexi SaaS minutes. Traditionally, AI Media's business has been at the very high quality end of live and recorded captioning. Since our EEG acquisition, we've also been able to deliver on the lower quality end of the spectrum, that is higher automation. And with our Smart Lexi service, we've been able to radically improve the quality of that automatic speech recognition output. So more and more content can be delivered that way. The great thing, and I'll get to that slide in a sec, about now having EEG in the fold is that it provides us a true one-stop shop for delivering captioning services for our customers, and also really importantly, the captioning infrastructure and the secure captioning private network known as ICAP. What did all that translate to? Well, it translated to a really big increase in gross profit. So a 63% increase in gross profit as opposed to 22% revenue growth, with that gross margin really going up from 41% last year to 55% this year. A $10 million turnaround in EBITDA, achieving EBITDA profitability. And really importantly, the revenue growth for the EEG side of the business is exceeding 40%. And we're expecting to see the trends continue, and we're certainly seeing a strong start to FY23. In terms of cash flow, the story is even better. So almost a $20 million turnaround in operating cash flow. A lot of this is due to containing our expenses while growing our top line, and also improving the amount of Lexi and Smart Lexi that's being sold, which doesn't have as high a cost base. It's anchored in technology costs, whereas our traditional premium services are anchored in human costs by the hour, which have obviously seen some inflationary pressures. One thing to note is that we believe the true line on net cash from operating activities is that 3.8 million. According to the auditors, we actually have to also include some acquisition costs related to EEG, principally the lawyers and advisors. And so the statutory net cash from operating activities is actually 1.9, but still a good turnaround on last year. There's sort of 4 broad customer needs that we're solving at the moment that you'll see as we go through the presentation. The top left one's probably the hottest at the moment, where we're seeing a lot of broadcasters for the first time really extend their broadcast platforms into OTT and IP. And we're very well positioned with that, with our Alta product to take advantage of that. And the really great thing about those customers, like Major League Baseball, for example, is they're starting to caption for the very first time on these platforms. And then because they're implementing a brand new solution, we get to install our infrastructure and then deliver the captioning across that infrastructure forevermore. But equally, we're not just talking about one channel. So for example, we're talking about dozens of different channels for most of these OTT platforms. In the case of NBC and Peacock, it was 60 channels. So you know, these are sort of large 6-figure accounts that we're seeing, and more of them. In terms of market fragmentation, we know, and this was even in our prospectus, as one of the reasons for listing, was to take advantage of the roll-up opportunities. And not only have we done that with some acquisitions, we've also launched our ICAP Preferred Partner Program and our Lexi Preferred Partner Program, and effectively allowing the mom and pop shops, the kind of smaller end of the market, and even potentially some of the larger players, and we'll get to this on the competitor slide, to actually be reselling Lexi to their customers. So improving our sales channel, and also improving the amount of ICAP traffic that we are actually managing to monetize. Meeting room accessibility, this is a great solution behind customers' firewalls to set things up in a secure one-touch way. So you go into any meeting room, you click on a button, and live captions and translations happen almost by magic, and fully within a customer's firewall. And then finally, there are tailored broadcast solutions that we're able to offer multiple legacy partners, and we've had some good wins on them as well. This is, I think, the really key slide that really, I think, first articulates what are the different elements of a product suite that a customer needs, and then how does AI media play in all of those spaces. So at the bottom, at the foundation level, we have the captioning infrastructure, the network infrastructure, which supports all the captioning infrastructure. That network infrastructure is the ICAP network, a fully flexible, secure private network. And what that does is it in itself is connected via a cloud, which allows us to, with these cloud connections, upgrade, improve the security and add features instantaneously to any of the captioning infrastructure that sits on the ICAP network. Now, if we move up in the pyramid, we get to that captioning infrastructure, and this is the traditional space where EEG have played for decades, and that was on the physical encoder side of it. So on the left there, they would have a bunch of physical encoders that they would plug into the broadcast equipment. They would get audio and video through, and then that audio and video is encoded and distributed to captioners in the case of the premium product, or to an automated speech recognition system in the case of Lexi. And then those captions are then put back into the broadcast stream securely and with very low latency, and then they appear on air. As I mentioned earlier, one product that's massively taken off is the one actually next to ICAP encode, and that's Alta. And what Alta is a virtualized form of these physical encoders, and customers receive from us software and a license key. They then install Alta on their own equipment, so it's incredibly secure, but also very high margin from our perspective, because there's nothing to ship instead just a license key. And as I said, that's been far and away a breakout product for us in the last 12 months, and we're expecting to see that continue. There's really nothing else on the market that can take any form of IP video in and encode it and then push the captions back. In fact, the closest solutions we have still require, the closest competitors we have to Alta still require something physically plugged in. Falcon, it is a cloud-based system where effectively you can be up and running in less than a minute. You just effectively get an IP address to point your feed to, and then everything's done in the cloud. Falcon is done for sort of web streaming and events, whereas Alta is more around the IP video and over the top, but both of those don't require any physical infrastructure. And then on top of the captioning infrastructure, the captioning solutions, AI Media traditionally started in that premium space. EEG started in that Lexi space, and Smart Lexi is something that actually is the AI Media Smart ASR solution combined with the best of Lexi. And then on the delivery platforms, this is how you actually get to see the captions. That can be embedded within the ICAP network infrastructure with an ICAP viewer, or it can be the AI Live display product, something that AI Media have used for well over a decade now. Now, I won't skip through every single slide, because I do want to spend a little bit of time on the more important slides. In terms of the key global sales wins, this is a really exciting slide for me, if only because there are actually three really key customer segments that we're seeing growth in. The first on the left is almost the lowest hanging fruit. These are customers, legacy customers of EEG, US broadcasters who have not yet used Lexi or Smart Lexi. And we saw ABC, Fox, NBC, and ESPN switch over in a big way in the last 6 months, and we're expecting further brands to continue. In the middle is also really important, because this is about our premium service. And I think a lot of people got quite nervous when we launched Lexi and Smart Lexi that somehow this was going to cannibalize all of our premium revenue. Well, that couldn't be further from the truth. What it's actually done is it's opened up more premium customers to us, because those premium customers recognize that some of their content is really, really important, and it's really important to get right. But not all of their content is like that. And so they want the ability to choose the most cost-effective solution for each individual piece of content. And then The column on the right is almost a bit of a teaser for future revenue. So this is really good early indications of customers that we've signed on and are moving across to ICAP and who are beginning their journey with Lexi and Smart Lexi. And this is really kind of our internal slide that we wanted to share with the market, because this is how we measure how well we're going, even week to week. And this is how much, at the bottom graph, how much is that ICAP network growing. That's important because it's a bit of it is a land grab effectively. And what we want to do is we want to extend the ICAP network from its dominant position in US broadcast and make it dominant around the world. We've got a great first mover advantage at the moment. A lot of the rest of the world is a greenfield site in the case of this infrastructure, and also Lexi and Smart Lexi. And that's why the timing was right for us to do the acquisition of EEG and to really integrate both businesses with the fresh strategy that we announced last November, which was to push forward with that focus on ICAP and Lexi, and also wrap around further uses of captioning in terms of sub-silo, which is something that we're getting really great traction with. And effectively what that recognizes is that when a customer has a caption file, that caption file can actually be used to search the media really effectively, because you've got a time code of where someone said something. You can then jump immediately to that time code, and that's something that's been adding huge value for a lot of our customers above and beyond the kind of standard captioning. There's some case studies, again, a mix of both the software as a service solutions for MLB and Sky News, and the premium services for Google and UK Parliament. There's just a bit of a change in the mix with North America becoming more important and live broadcast becoming more important. The growth in our SaaS revenue has increased from 6%, albeit for a part of the year, and a 30% mix at the end of the year, which really has driven that improvement in financial performance. So the financial performance, a bit more of a breakdown. So we got to 60.1 million in revenue. This was against a guidance of 60 to 62. The reason we came at the bottom end of that tier was because we had a few delays to customer implementations, which we're still experiencing, to the tune of about $1.5 to $2 million. So not huge, but these are customers like GB News who haven't been able to secure other component parts to complete the build of new equipment. In terms of the balance sheet, we've got 15.2 million in cash. We did secure a deferral of the earnout for the EEG vendor of $4.6 million US, just to maximize the opportunities that we have for cash in the year ahead. There's a bit of a waterfall on the cash flow, and this slide I did just want to spend a little bit of time on, because this is the first time that we've really put the combined competitor mix on one page. So both the traditional captioning competitors in Verbit, Redbee, 3Play and Rev, and the infrastructure competitors in Enco and Evertz. I mentioned that I'd talk about the partner program when I got to this slide, and that really is around those captioning competitors, so Verbit, Redbee, 3Play and Rev. At the moment, they are utilizing our ICAP network to actually deliver their captions. And so we are exploring a more formal way to effectively monetize that network for AI Media and its shareholders, building on the business model that was EEG. At the time, EEG as a standalone business didn't need to monetize that ICAP network, but as we continue to invest in the ICAP network, as we continue to improve its security, as we continue to improve the qualities and features of Lexi and Lexi Translate, it is appropriate that that be better monetized. There's just some detail on sort of the macro environment. There's nothing particularly concerning in terms of those supply chain constraints. I think in terms of inflation, we have options here. We have increased our hardware prices by 10% twice in the last 12 months without seeing any pushback. We aren't increasing the prices of Lexi or Smart Lexi. That is still in that land grab phase, and that cost base isn't subject to the strong inflationary pressures because it is a technology-driven solution. And then in terms of regulatory tailwinds, you know, there continues to be further improvements in the regulatory settings. And as I said, it is now about those partnerships driving our growth. A few more details there on the partner preferred program. The roadmap to 2025 really is we got a pretty clear view for the next 3 years about what we need to execute now that we have AI Media and EEG together. It is establishing ICAP as that global standard. It's growing and diversifying that customer base outside of the US, outside of broadcast, increasing SaaS and devices as a revenue share. And again, that's happening by upselling our existing customers base outside the US and also new customers, and continuing to enhance that product suite and technology, again, towards better accuracy and ever more security. And then there's just some key takeaways, and I might just pause there because I'm a minute or two over and just see if there are any questions.
Thanks, Tony. I might just kick off the questions if I may. Penetration of, you know, Smart Lexi into the existing customer base that you have, or are those more premium products? In terms of, you know, the customers that you have, you know, you would probably say, okay, XYZ customers, you know, we can definitely upsell them here. It's just a question of, you know, kind of converting them and getting on board. How far do you think you are in that process in terms of the existing customer base of like trying to move them up the value chain into these more premium products?
Yeah, great question. And you know, that's you know, one of the key drivers of the success of the business. And I think if I pull back to that slide on the customer wins, that'll probably help me talk a little bit more about where we are in some of these. So this is the column on the right, effectively, that question refers to, right? So how can we actually move those high cost, high price premium customers across to Lexi and Smart Lexi, and how long does that take? So the first customer we did that with was Sky News Australia, and they moved last year, end of, so I think it was October of 2021, all the way across to Smart Lexi, and they did that because they wanted to caption all of their content. And the regulations at that time only required them to caption 7 hours, and they only had a fixed budget for captioning. So we were able to effectively let that 7 hours of captioning budget stretch to 24 hours. But we also had to have engineering conversations with Sky News because the really important thing about making Lexi and Smart Lexi work is the quality of the audio that we're getting in. Because you're using the direct audio to actually generate the captions in an automatic speech recognition sense. In a premium sense, you're not, because you're either relying on a stenographer listening to it or a re-speaker listening to it and then repeating it. And so the human ear is much, much better at certain things than computers are. One example of that is crosstalk of people interrupting each other. Music in the background, sound effects, you know, someone speaking a different language. None of these things automatic speech recognition can sort out. So there is a varying amount of discussion and engineering work that has to be done by these customers in order to make Lexi and Smart Lexi work. In the case of Sky News, it was minimal because we're already getting studio quality audio from presenters on air and there's very little, by the way, of, sport or, background noise or talking over each other. But it's not like there's zero of it. So, for example, when we were captioning for Sky News, the election, the recent federal election, we chose to put on premium captioners when it was the really important content, like they were hosting a debate. Because that was going to have people talking over each other, and you were going to get crowd noises and things like that. So it's recognizing that there are always ways to improve the amount of content that can be done more cost effectively, and having those conversations with customers. We're in early conversations now with 7 and 9, who are our 2 largest customers around this. We've implemented it with TVSN, but still, I would say, the vast majority of that transition mark is still ahead of us.
Okay, and then one from the audience here, Tony. Have you considered entering the broader video creation space? And the question is around, he says, thinking corporate videos, so whether they be training, promotional, recordings of conferences, that I'm guessing that kind of whole spectrum for more enterprise clients, I guess.
Yeah, look, it's a good question. And there's the market itself that we're talking about here in the language services industry is 30 billion. And where we want to focus is what is on this slide. So if it's on this slide, we do it. If it's not on this slide, we don't do it. We have partners, etc. In terms of recorded media, which is kind of the broader case of that particular example, we very, very, very deliberately moved away from recorded media as a focus in the last few years, because we've got such an advantage in live. And all of this is really to deliver live solutions. And you go, but you've still got 18% of your business is recorded. And that's true. So, 1/5 of the business that we have is recorded media, but that's down from 50% 3 or 4 years ago. And most of that 18% comes as a wraparound service where most of our customers initially want live. And then once they have live, then they can use those captions after the fact. We can tidy them up, et cetera, et cetera. So in the case of enterprise customers, we're more focused on enterprise customers that actually need a live solution. So, we're very interested in pursuing, again, early days, but, the large professional services companies who, want to make sure that each of their meeting rooms are accessible, and also where you can have live translation fully securely behind those customer firewalls. So that's more of the customer type that we're looking for. It's A, it's better revenue, and B, it has a longer tail in terms of the ability to deliver really scalable technology-based captioning and translation solutions. There's many competitors that do fast turnaround on recorded media content. And in fact, 3Play and Rev that are on slide 20 of this deck, that's kind of their bread and butter. So our focus is actually on tapping the much bigger markets that we're seeing with the solutions on this pyramid.
And then just a final one for me was actually one that was sent in ahead of time. Where would future acquisitions be targeted at? They want to know, would it be to get customers or into specific geographic markets, or would it be more of the line of getting you a specific piece of technology that could be integrated into one of your offerings?
Yeah, absolutely the latter. So we already have a sales force, local sales forces around the world. And in fact, we've been investing in that since before we listed. And we have a sales team of over 30 people, 10 of whom are at a conference right now in Amsterdam at IBC. No, the value that we will, so we don't need, local sales. And in fact, we've shown a real ability to make sales in greenfield conditions. What we absolutely are focused on is improving this pyramid. And improving this pyramid will come by either, improving the security and reliability of the ICAP network. So there could be a technology addition there. In terms of the physical, virtual, or cloud-based captioning infrastructure, that's really our bread and butter. Like, we write that code, we own it, we build it. There's no real acquisition that we're looking for there, nor do we think that we need one. However, where there is a lot of scope for continuing technology development is in the captioning solutions. So, could we get an even smarter Lexi? Could we improve the quality of Lexi? Absolutely. And we do that every week effectively with our Lexi lab that we're running to. Are there interesting technologies and solutions that could improve that? Absolutely. The translation space, the live translation space in particular, is one where there's very, very interesting technologies that are coming up, and frankly, they're at a much better price now than they were 12 months ago. So we're definitely keeping our powder dry in terms of that capital and acquisition opportunities.
Tony, we're going to have to leave it there. Thank you very much for coming back in and giving us an update on all things AI media. And yeah, we'll keep an eye out for further announcements over the next 6 to 12 months, and we'll get you back in again, I'm sure, in due course.
Thanks very much, Mark.
And now I'm delighted to welcome back another returning presenter, Iain Dunstan from Gratifii. Iain, if you want to start sharing your presentation, I'll let you know when it's up on screen. I can see it now. If you just want to go to full screen mode or slideshow mode, Iain, just so we get ahead. Yeah, there we go. Perfect. I think you're still on mute, Iain, if you just want to take yourself off mute.
Off mute?
Yep, I can hear you now, Iain. You're good to go.
Great. Okay, so essentially Gratifii is a loyalty and rewards SaaS technology company. You're built as SaaS from the startup, all new microservices technology that allows customers to deliver a faster and better experience to their clients. So together with that software, we also provide the rewards content that loyalty programs require. And we also have a managed services team, which will help them design the products that they're delivering. So we've positioned ourselves as a true end-to-end provider of loyalty software and services. I think one of the really interesting things right now is post-COVID, there's been unprecedented market growth in the loyalty and rewards space. The market is expected to reach $226 billion over the next few years, and 88% of all Australians are involved in at least one program, and many more. I think people probably don't really grasp the size of the opportunity there is in this space. 90% of all the companies have a loyalty program. And so if you think about it, that's just about every hospitality group, every financial services group, every health services, telcos, aviation, sports clubs, tourism, insurance, retail. All these industries have loyalty and reward programs. And we've seen from industry research that's come out recently that over 60% of all companies in this space intend to increase or significantly increase the development of their loyalty strategy over the last couple of years. So it's actually an extremely rapidly growing space at the moment, with opportunities across thousands and thousands of companies. And I think that's one of the things that people probably don't grasp, is actually the size of the opportunity and the size of the market that we operate in. So, we don't need to get a particularly large market share to really grow rapidly. If we look at where we are today, we recently acquired about a month ago a company called Hachiko, which is a company that does the front end engagement, designs the products and builds the front ends, which was the last piece of our puzzle. Now, post that acquisition, if we look at FY22 pro forma, the combined entities did just over $19 million of revenue, and roughly break even. I think pro forma we were showed a loss of about $300,000, but already since we've acquired Hachiko, we're working on delivering about $600,000 of synergies. That's across finance, shared services, legal, marketing, hosting, things like that, which puts us in a pro forma profitable position. We acquired Hachiko for about $3.6 million. It's delivering, last year delivered 7.2 million of revenue and EBITDA of 600,000. They'll do better than that this year, and that's before we even identify the number of cross-sell opportunities which have already started to come to light. We pick up 20 highly experienced people, which, as most people would know in this market, experienced people are hard to come by. The founder of Hachiko, Katrina Kerr, has joined our board on the 1st of September as a non-executive director. As I said, we've started to move the people into our office, and we're moving out of their office as part of the synergies that we're getting, and we're starting to cross-sell to their client base. So the combined entities, we have about 85 enterprise clients using our software in some way, shape or form. As I said, why did we acquire this business? Essentially, our core business has been the API-based SaaS loyalty and rewards engine, which is used by a number of companies globally. Last year, we acquired the Need Ideas business, which is the content business. And so the last piece that we found where, for instance, we won a substantial deal with the Seagrass Hospitality Group that own Meat and Wine Co, Hunter and Barrel, five brothers, a whole bunch of different, 7 different hospitality businesses, that we had to outsource the building of the apps and the front end in order to deliver that project end to end. Now, with the acquisition of Hachiko, we can deliver the front end plus the design of the programs, the technology to run them, and give the people the content that they want to hand out to their customers. So they're the 3 pieces of the puzzle that people want to come to one single source that can deliver all 3 pieces. To date, it's people have got their engine from one person, as we've had to do to date, get their app and web engagement delivered by a different company, and then go and source their content from a third company, which means a whole lot of APIs have to be built, a whole lot of making all the pieces work together, or where you didn't get them from one place, difficult to make all of that work. We can now deliver a single end-to-end solution to all of our corporate clients. And not only end-to-end, but we believe that we've chosen the best in each field. We believe, and we've certainly heard from the customers we're working with, that our SaaS loyalty engine is the best in market. We're able to do things that other companies cannot do. If we look at one of our large enterprise clients in South Africa, we were able to deliver a new program for them for a tenth of the cost that they were quoted by one of the big global players. And one of the big global players said it would take them 12 to 18 months to deliver. We delivered it in 6 weeks. They'd been quoted 2 million to build it. We built it for under 200,000 and had them live within 6 weeks. Now, that client a year ago was paying us around about $3,000 a month. That was in May last year. That client now, with transactional revenue in August, paid us $170,000 in license and transaction fees. So between May last year at 3,000, they've grown to 170,000, and we believe there'll be over 200,000 a month by Christmas time. So, we're delivering, and that client said it's the best loyalty rewards program used by that company globally. Now, we only run their South African business at the moment, and they're a very large global multinational. And they said the product that we've delivered, they've never seen such a response from a loyalty program as we were able to do for them. So with that engine, we've now, Need Ideas is the largest now supplier of rewards in an Australian company. There are a couple of larger international companies, but we have the largest domestic rewards program. And we now are delivering rewards to over 10 million, access to over 10 million users in Australia can access our rewards through our large clients like RACV, Alinta Energy, HBF Health, to name a few, plus all of the Coles, Bunnings. So, and that's growing rapidly particularly post-COVID, as people are going to the movies, they're dining out, they're going on more holidays. We have more holiday destinations, more travel services, and we're growing that product post-COVID. We expect the revenue in that business to grow, as we forecast, at a better than 30% per annum rate. And now with the front end development, we can make it seamless, and we're already cross-selling, as I said, to the front end people, our back end, and we're working on joint Gratifii Chico opportunities already. So where we are today, we have about just under 60 people. We have 6 offices around the world, 2 in Australia, New Zealand, South Africa, Singapore, Dubai. We have around about 85 customers. As I said, revenue last year would have been just a bit over 19, and as we forecast, we believe that will grow strongly this year. We have a market cap of about 17.2. I don't know too many SaaS companies globally that has a market cap less than 1 times revenue. So that's well below industry comparables. If we look at where we sit versus our competitors, we traditionally come up against, there's small players that have a more like a Xero type equivalent in this field, where their companies will pay anywhere between $1,000 and $10,000, $1,000 a month, $500 a month, $1,000 a month type of stuff. For SMEs, it really does, they don't have a lot of functionality. They're really just a digital version of a coffee card. And then even if we look at the really big global players in it that we come up against, they really are old software now. They're not SaaS per se. They might have been reconfigured to be able to be used as SaaS, but they're not natively SaaS. Traditionally, they only do one piece of the market, not all of it. And interestingly, we do find a lot of the time that people will bolt our software onto a Salesforce or an Oracle or a Microsoft platform in order for us to be like the icing on the cake, where we will add functionality. They may well contain the customer details in the Salesforce or Oracle or Microsoft platform, but we will provide all of the loyalty reward functionality, the setting up of the tiers, the products, the rewards, all the pieces they'll do in our software because it's substantially cheaper, substantially quicker, and substantially better for their clients. So what we see is in that instance, we will work with the big players like Salesforce and Oracle, and generally they're very happy to work with us because it's very difficult for them to do what we do and would normally have long lead times. So they focus on their knitting, and we are often the icing on the cake for the big guys. So we're able to play from relatively small players. Our sweet spot is generally in the, I'd say, $200,000 to $500,000 a year. We don't really play or want to play down at the SME platform end, but we'll deal for the mid-tier organizations that can't afford the big global solutions or need more functionality than the big global solutions have. So we found a very nice sweet spot in that sort of $200,000 to $500,000 a year space. If we look at the numbers, we're growing. I think we've had six consecutive quarters of better than double-digit growth. We see that continuing into the foreseeable future. We've finally crossed over that operationally. We're profitable. And we have quite a substantial R&D program in place to continue to enhance our product. To give you a bit of a feel for how fast this business has been growing, we, in the last year, we really only launched the new Mosaic software platform on the 1st of October last year, where we only had a couple of opportunities in the pipeline. That's grown rapidly, down to the extent that we are in contract negotiations for right now for 4 new enterprise clients that we anticipate we'll have those signed off within the next 4 to 8 weeks. And some of those are quite substantial organizations. So we're really starting to see, as I said, it's a very hot space to be in at the moment. Loyalty and rewards on a global basis is rapidly growing. People are looking, and again, in tough times, all the research shows it's much easier to get new sales from existing clients than spending the money trying to attract new clients. So we're seeing organizations turn inwards in order to generate growth at a lower cost. I saw some interesting statistics yesterday that Country Road, that nearly 70% of all their sales are attached to a loyalty program. So, we're really seeing in a post-COVID world, organizations really putting a lot of time and effort into their programs in order to maximize the revenue out of their existing client bases. So we've seen that pipeline. We're currently working on a lot of opportunities. We're probably picking up 2 to 3 every week at the moment would be coming in. And as I said, we hope to announce 4 substantial new clients in the next couple of weeks at a minimum. So post the acquisition and where we positioned the company, we believe we've got the best software in the market, and a number of very large organizations have told us that. We're able to use all of the industry consultants are now sending business our way, and we've won a lot of business through industry consultants, and they are engaging with us more and more and more. And as I said, the rewards business itself is growing rapidly as well. So right now we're seeing, each quarter, we will see September quarter will be, we'll deliver better than double-digit growth again for the 7th consecutive quarter. And that's September's normally a relatively quiet quarter for us. December's a big quarter. I expect to see substantial growth in the December quarter. So we're really happy where we are right now. We've got a growing pipeline. We've got an end-to-end product. We've got a lot of new clients coming on board, existing clients ready to go live. It's an active sector, and as far as we're concerned, we're seeing all the planets align, and we think the future looks bright.
Thanks, Iain. Questions have been flying in while you were talking there, so I'm just going to start with them now. How is the revenue mix, and do any customers make up a material percentage of the total?
Look, RACV is our largest client. They would represent about 12% of our revenue. So they're our largest client. We had a client in South Africa that would be probably 8% of our revenue, and the rest is pretty evenly spread across the other 83 clients. So two very large clients at the moment. And then a lot of people in that sort of 250,000 type per annum.
And then another one, what proportion, this is probably just a rough guess, what proportion of existing loyalty reward programs in the industry are run via, in-house CRM or some software, versus, a system that you could offer?
Yeah, look, the number of people running internal systems would be disappearing. Very, very, very few. I mean, you couldn't possibly run an internal system for the cost that, if you're replacing an Oracle or a Salesforce, you could potentially do it in-house. But, for $200,000 a year, now that's 2 salaries at best. So we just don't see many people running their own in-house programs on CRMs. And as I said, they can always take modules of our stuff and bolt it onto their existing system. We're quite happy to do that. And invariably, like for instance, if we look at Seagrass that we're rolling out, we're integrating to their point of sale, we're integrating to their booking system, which is a global booking system. So, what they're going to do is really clever things like when you even book your table, they'll know who you are and they'll know what you like, and they may well offer you, you know, I know from the number of times you've been here, you always drink Shiraz. So when you book, they'll say, hey, we have a special on Penfolds 389 coming up, 30% off, keep your eye out. So even when you book, people will start to push out your specials and deals and rewards as we integrate right through the booking system. So the whole sector is getting much smarter, and, you know, not just this sector, but as you know, global sectors, it's all about data, you know, and knowing your client. So if you go to Meat and Wine Co. Barangaroo, if you go to Meat and Wine Co. in Dubai, they'll know what you like to eat, what you like to drink already, and can treat you like when you walk into Dubai, even if you've never been there, they'll go, well, Mr. Smith, you know, we know you like Wagyu. We have a special on Wagyu if you're interested. So, you know, you feel special, you feel welcome, you feel it's worthwhile being part of their program. So the days of running stuff in-house, I think, is pretty much coming to an end. It's just not economic.
And then another question, do you anticipate gross margin improving with the new SaaS deals going live?
Yeah, quite substantially, because, you know, the SaaS side runs at sort of traditional SaaS margins, 80% gross margin, 40% net margin. So, you know, the more 80% gross margin deals you can do, the better your overall margin is. We see the business overall as about a 60 to 65% gross margin business. We're probably currently running about 40. So yes, we do see the margins moving up towards that sort of 60, 65 level over the next 12 months.
And then another one, I mean, you talked about the latest acquisition, kind of, you know, fully building out the kind of technology stack from top to bottom now, but there's another question on acquisitions in the loyalty space. Is there anything else out there that would make sense to widen your product offering, or is it a case, you know, you've got the three main components and through your own in-house R&D, you can add bells and whistles if and when needed now?
Correct. Look, we're not actively looking for any, we don't need any pieces. I think there may be, similar to the last presenter talked about, you know, some roll-up opportunities potentially from some smaller players. The other thing is potentially in the data analytics space, but, you know, not substantial and not anything where if they fell in our lap, we might look at, say data analytics or scale. But, you know, exactly as you touched on, we believe we've got the three main pillars that we need now, and anything else is just a bolt-on.
Yeah. And then another question, how do you attract clients? You know, do you have a large sales team? Is it referrals from other customers? Just talk us through that.
Mostly through industry consultants. And the good thing for us is in all the markets that we operate, there are fairly large specialty providers, consultants, and we've now won business in each market that we work in through the leading consultant. And once you start to win business with the leading consultants, they just keep bringing you businesses. So that's one thing that we've really matured in the last 12 months, that we now are always invited to tender. Now, whether we win or not, that's up to us, but we are always invited to tender or work with pretty much any opportunity that comes up now. And that is the reason why our pipeline has grown so rapidly. Yeah, we actually run a very small, we have one SaaS salesman in Australia and one reward salesperson. We have one SaaS salesperson in South Africa, one in Dubai. That's it. It's all mostly through consultants, and we don't see that changing. And with the pipeline we got, we really don't need to chase anymore.
Okay, perfect. Iain, I think we'll leave it there because we're just up on time, and I know Mohan has just joined us, who's going to be our next presenter. So thank you very much for coming back in and giving us an update on the business. And yeah, we'll keep an eye out for contract announcements over from now on to the run into Christmas.
Great. Thanks for the opportunity.
Thanks, Iain. And I'm delighted to say now we've got Mohan with us. Mohan, if you want to just start sharing your screen, I'll let you know when I can see the slides coming up now. It's just coming through now. Yeah, and if you just want to go to full screen mode or slideshow mode, just so we get it onto the full size. Yeah, go across the nav bar there to, yeah, there you go. Perfect. Just you're still on mute, Mohan, if you want to just take yourself off there.
I think that might be better. You've got me there, Mark?
I've got you now, Mohan. Yeah, you're coming through loud and clear.
Hello, everyone. Mark, thank you for the opportunity. This is the second time we've presented to your audience. I hope you're all well. I've got about 20 slides that I will speak to, and then we've got time for Q&A. So if I could take you through my deck, there's the usual disclaimer that I'm sure you're used to seeing, and please take time to read it when this goes up on our respective websites. Today's about taking you through our results for last year and letting you know what to expect in terms of performance for this coming financial year. FY22 was a super year for X2M. We listed, we did all the things that we said we would do and some more. So our revenues were up 82% year on year. The base, we delivered $10.4 million of revenues last year. Connected devices, which is a very important metric for us because that's what drives future SaaS revenues, almost double. We were up 99% year on year. We're a B2B company, digitizing utilities in the APAC region. Our customers have large consumer and residential bases. Our customer base was up 35%, and I'll talk to you about the size of the opportunity that represents shortly. On the back of 82% revenue growth, OPEX was up 40% year on year. That was largely driven by expenses associated with being a listed entity that we didn't have the previous year. Typically in this company, we should be able to drive 70 to 80% revenue growth with 10 to 15% OPEX growth, and that's what investors should expect. We set ourselves up very well in Q4, in particular for FY23. We have executed 19 enterprise and government contracts that will deliver $11 million of revenues this financial year. So that's contracted revenues, and some of it we've already been paid. And so importantly, 9 weeks in to the new financial year, we have got contracts that have got us ahead of last year's full year results. So expect 23 to be a very strong year. And as I said before, we listed on the ASX this year. Our results for FY22 were not a one-off. And what this slide says is that since incorporation of X2M and acquisition of Freestyle Technologies assets, the company has delivered really strong results year on year over the last 3 years. And what you've got here is revenue growing from a mere 1.3 million through to 10.4 million in FY22 2022. FY20 was a part year. If we were to normalize that for the freestyle component, that was about $3 million. Connected devices have gone from 63,000 to just shy of 250,000, and enterprise and government customers also grown very, very strongly. In terms of some more detail on our results for the last 12 months, on the back of really strong group performance, in the big contributors were South Korea and China, both technologically highly developed nations embracing our software, our platform. South Korea was up 64% year on year, China up 202% year on year. I spoke about the growth in our customer base. SaaS revenues were up 30%, and we're expecting that to accelerate as our base of connected devices have grown. And you can see in that middle column, South Korea connected devices up 86%, and Japan, where we license our technology to one of Japan's largest water and gas meter manufacturers, connected devices up 133%. And we don't expect that growth rate to abate. And in fact, as we speak, we're deploying to something like 30,000 households in South Korea. I'm looking forward to the balance of this year. I've in my career never started a year as well as this year, and as I said earlier, 19 contracts secured. That's already put us ahead of last year's full year results. What we do briefly, to give an example of what the technology does, in South Korea, we're digitizing water. We have about 25 municipalities where we help them with water management. Our technology provides them with productivity improvement. We automate manual processes. It reduces waste. We detect leaks. We provide them with data for analytics and smarter operations and improved customer service. Before we came along, meters were analog. They were in a pit underground. Meter reading was manual. The pits filled up with water. Rubbish got dumped on them. Meter reading was inaccurate, and the customer was losing something like 20% of clean, billable water to undetected leaks. And if you can just reduce that by a quarter, you've paid for the business case. And we had our first deployment in South Korea some 5 years ago, and that's just gathered momentum. And as I said, we've got 25 municipalities now that have contracted us, and every day we're rolling out our technology to their residential homes. In Japan, 50 million households, about 24 million of those are on bottled gas, because Japan doesn't have mains gas, natural gas. And so if Mark was to run out of gas today, the truck will be around delivering him a replacement bottle in the next day or so. And if his neighbour runs out in a couple of days' time, the truck's back there. Our little chip goes into the gas meter. We collect data for our customer. The customer analyzes it and can predict who's going to run out when, and then organise the logistics management. And we've given them the Uber map. And the result of that is delivery days are down from 6 to 5, kilometres travelled down by 29%, fleet down by 20%, and overall OPEX down by 20%. So a really, really compelling business case. Our customer has a market share of gas meters of about 30% in Japan. So we believe there's an addressable market in this sector through our existing customers base of about 7 to 8 million households. And we've just clicked past 150,000 households. Smart communities is what we're rolling out here in Australia. You know, today with normal households, all the challenges around energy prices and the impact on the environment. A third of Australian households have solar, and that's a good thing. With solar, you get free energy when the sun's shining. When the sun's not shining, you buy off the grid, and typically you buy off the grid when everybody else is buying off the grid. Prices are greatest at this time, and if you've got excess capacities when everybody else has got excess capacity, everybody else with solar, and you have trouble selling it into the grid, and if you do, what you get, the reward you get for it is small. What we have introduced into Australia on the back of contract wins in the space in Taiwan is the concept of smart communities. So this is where, particularly for greenfield infill developments, but not exclusively. It might be retirement homes, it might be caravan parks, retirement villages. We have new subdivisions. So our first contract was in Echuca, 1,000 households, and they all have solar on them. There is a home hub that connects that solar with a range of high energy using appliances in the home, typically hot water, heating systems, and air conditioning systems. The excess solar gets stored in a community battery, and you get a credit for it. And at night, when you need, when there isn't sunshine and you need to buy normally off the grid, you would go to your community battery and you draw from that, and you draw at prices that are cheaper than you would buy from the grid. The result of this is that total energy consumption reduces, the volume of renewables and the effectiveness of renewables increases, the level of carbon emission and the carbon footprint reduces, and the residents should see a 30 to 50% reduction in their energy bill. And on the back of announcing our first deployment in Echuca just 3 months ago, we have built a really good and strong, steady pipeline, and we're really, really excited about this space and the contribution it could make to Australia in its journey towards net zero. What makes us different to other technology providers? We've got about 4 or 5 key differentiating features with our technology. We can put any device onto the one platform and have those devices talk to each other, and that's a patent that we've got. So a smoke alarm that detects smoke and shuts a gas meter off is our speciality. We can take old digital devices that can't communicate and put a little chip in it and make it communication capable. And indeed, we can take an analog device and retrofit that with our technology and make that communication capable, and in turn go back and control that end device. This significantly alters the customer's CapEx requirements, and so we tend to win the cost battle every day. We can operate across any telecommunication backhaul, 3G, 4G, 5G, Ethernet, and the ability for a micro engine to determine what it's talking through is our patent, so our customer doesn't have to take big bets on technology. And finally, we can operate centrally in the cloud or at the edge of the cloud, what Cisco calls the fog, which means that in the event of an earthquake, for example, or a tsunami or a bushfire, if power is lost, if telecommunications is lost, we can continue to operate. We can shut down a gas grid. It also means that we have a highly scalable operation at a very low cost base. Those are the features that have come together to give us the very strong position that we've got in technologically advanced countries like Japan, Taiwan, South Korea, and in China, Beijing, where our operations are, and in those parts of the world where you see very little foreign players. The announcements that we have made over the last 7 or 8 months, give you a really good perspective of the momentum in this business. When we listed, we promised a strong flow of news that'll arise as a result of securing tenders. And what this slide shows you is just over the last 4 quarters, we've secured over $15 million worth of contracts since we've listed, and all with substantial government or utility customers. This graph here highlights the momentum in the business. Our first 50,000 households that connected onto our platform took us 6 years. In Q3 of FY21, the second 50,000 was connected in just 15 months. The third 50,000 was connected in just 6 months, and the last 50,000 was just connected in just 3 months. And that's the momentum that we're taking into FY23. SaaS revenues continues to grow strongly. The colours that matter here are the dark blue colours. So this is the growth in SaaS revenues. The top bits are some hardware revenues that were on a leasing arrangement that will fall off. But pure SaaS revenues are up about 30% year on year. The addressable market, our strategy has been a land grab to secure enterprise and government customers with a large addressable market. And what this graph shows you here on the left-hand side is the South Korean market. The total addressable market, in our view, is just shy of $1 billion. Our existing customers deliver us about half of that. To date, our penetration is set out in the turquoise colour, and the grey one shows you the progress we've made just in the last financial year, and shows you the momentum. A customer deploys this technology to a business case. They don't realise their business case until they've filled their total addressable market, because they are looking to replace meter readers. They're looking to replace to stop lost quality water. So you should expect that over the next 2, 3, 4 years, that this the turquoise blue will get larger and fill up that page. And a similar story in Japan, where there's 50 million households, 24 million on bottled gas, and our customer has a market of that 7.8 million, and we're rapidly penetrating into that market. And what this slide shows you is that journey. So Gaichang, our very first customer that we acquired in FY17, we have now got 100% penetration of that customer. And similarly, the municipality of Oxion that we captured in FY20, we've now got 80% of that municipality penetrated. And the city of Bucheon, which is one of the larger municipalities in South Korea, they first came onto our platform in 2019, and we've got about 30% of that municipality penetrated, and they have now announced that over the next 4 to 5 years that they'll have 100% of their households kitted out with this technology. In terms of the numbers, you will see I've spoken about the growth in revenues. Cost of sales follows the revenue growth trajectory. Gross profit up a nice 44%. You won't see the 40% type growth in overheads going forwards, because you'll have comparable year-on-year numbers. We are investing for growth, so you should expect losses, but you're seeing and you should expect that number to materially come down in this financial year. And my final slide rather. FY22 was very good. FY23 is positioned to be better. We are already over 300,000 connected devices on the platform. 55% of our revenues are coming from existing customers giving us repeat orders, which is a very, very good validation of our technology, and it also sets the scene for future growth in years to come. And we're delighted with the first deployments here taking place here in Australia. Mark, that's the end of my presentation. I'm happy to take questions.
Thanks, Mohan. I just want to go kind of focus on South Korea for a second. You said you've got 25 municipalities as customers currently to varying degrees. Like, of the total country, how many municipalities are there in total? Is it 50, 70? Like, how many are still untapped completely for your offering?
There's about 160 municipalities in South Korea. About half of them, only about half of them, own their own water and manage their own water. The other half, water is managed by the K Water Corporation, which is the government-owned water body. And so we've got about a third of the available, a bit more, about 40% of the municipalities that own their own water on our platform. And in addition to that, K Water also now use our technology. So our tentacles are very broad.
And then just sticking with those municipalities, I know you showed on the pie charts kind of flowing from initial customer sign up to penetration. It looked like a 3 to 5 year kind of period to get, you know, most of their customers on board, be it 80 or 100%. Is that fair? So like when we see, you know, these new contracts come online, that it'll be a kind of a 3 to 5 year process for you to, you know, bring all of those customers, or indeed the municipality, to manage that changeover process with customers. Is it kind of would that be fair to say, a 3 to 5 year process to, you know, get fully embedded into that municipality?
And that's right, Mark. So typically what happens is that the municipality has done their business case that says, actually, we want to digitize and we want to use this internet-based technology to achieve that. And they would then schedule their CapEx profile for migration from the old analog world into the digital world at a rate that is quicker than the normal deployment cycle. And so that's where your 3 to 5 years comes. And for us, what that means is actually a really good steady flow of repeat orders or recurring orders from our existing customers. And in addition to that, we were awarded a certificate of performance excellence by the Korean government, which is about a 2-year process you've got to go through. And we're one of only 2 players that have got that award. And what that means is that these municipalities, it means that we're on the municipality's procurement website, the central government's procurement website. So these municipalities can go straight on to what's called the PPS system and click and collect, and not have to go through tenders and RFPs and so on. And it also means we can enter into what the government calls private treaties with municipalities, where they can place orders directly with us.
Yeah. And then just on a more broader thing, it was a question that came up in the last presentation, customer concentration, given, you haven't got, thousands upon thousands of direct customers, obviously end users it is. So is there, one municipality currently that, is, let's say, greater than 10% of revenue, or are they all varying degrees of single digit percentages?
It's so we don't have one customer that dominates, and we like that. We've got a good spread. We've got over 50 enterprise and government customers, and we've got our business spread beautifully across all of those customers. So we're not exposed to any one customer. I should also add that once you've installed this platform and replaced your old technology with this, it's very hard to pull it out, right? Because if a municipality was to, if the municipality of Buxion, which has got 30,000 meters connected, if they were to swap us out, they have to go and buy 30,000, $3 million worth of new water meters to replace us, right? So it's a really sticky business. We've never lost a customer.
Okay. And then just given the nature of your business, I just wanted to touch on currency impacts. So when you're billing people in South Korea, do you bill them in Korean won, Australian dollars, US dollars? Because I see, the Aussie dollar, Korean won, it's like over 900 now. So I'm just trying to get a flavor for, given where, currency volatility is at the minute, how that impacts you translating back into Australian dollars for reporting purposes.
So firstly, operationally, we match our costs and revenues in the same currency. So the shifts in currency only impact to the extent of reporting, if you like. So we're not ever exposed to losses on currency. So we manufacture in Korea, we deploy in Korea with Korea resources, and we build in Korean won, and then when we consolidate it into our accounts, we consolidate it on the average price at the end of each month, and of course that can vary, but it doesn't really impact anything, because we show the normalized figures if there's a material change in exchange rates.
Okay. And then maybe a final one. I know things are improving in terms of, supply chain and logistics. staff seems to be the new problem facing every business. In terms of having hardware to deploy, getting it, having people to swap out old systems, put in your new systems, is that a major kind of concern, or one that's lessening over the last 6 months? I'm just thinking, you've got all these new contracts, like how difficult or easy is it, given all these kind of COVID hangovers, to actually implement it in the time frame that you'd like?
So it's getting access to component parts hasn't been difficult for us. We reasonably stockpiled, going back a couple of years ago. And if there was ever an impact, it was obviously, we would have expected costs of component parts to have come down rather than stay at the levels that they were. Having said that, we redesigned our communication chip, so we were able to get some realize those cost savings anyway, and we're getting to a fairly normal state now. So the global demand for component parts is not impacting us.
And then the final question then, I think, is the Australian market. Replicating the South Korea market with the with councils across Australia, is that a viable growth strategy on the water side, obviously, or is it more of, if we're going to see expansion in Australia, it's going to be more of the Echuca style projects?
Look, both. So the energy space and smart communities, smart commercial buildings, smart residential buildings is ready for the picking, and so we are expecting really good growth in that sector over the next few years, and we're seeing a lot of activity in the water space. So the key water authorities in Australia have been doing a lot of work getting their head around this technology and formatting their go-to-market strategies, and they're behind countries like Korea and Japan, but I would expect to see activity in the water space certainly in the next 12 months.
Okay, great. Mohan, we're just about up on time, so I think we will leave it there for now. Thank you very much for coming back in and giving us an update on all things X2M, and we'll monitor announcements as they come through over the next few months.
Thanks, Mark, and for those that are online, thank you for taking the time to be with us today.